What does Grant Cardone, Ken McElroy, The Real Deal, Biz Now, and others have in common? Well, it's that they're all listening to the Gray Report podcast YouTube channel, and they're signed up for our newsletter because here at the Gray Report, we're covering all of the latest research and data, breaking it down and analyzing it relative to the multifamily industry, commercial real estate, and the economy. So if you're an active investor, passive, somewhere in the middle, you are in the right spot. Because every single week on the Gray Report, that's what we're doing. We're breaking it all down so you have the absolute best information so you can make some incredibly informed decisions. Again, we're talking about multifamily investing, real estate, and the economy with original insights and opinions from the Gray Capital team. We've got some great reports today that Dr. Matt Bosnagle has put together. Report from RealPage, Berkadia, CoreLogic, some announcements from the White House, some AI stuff from JLL, Globe Street. You are not going to want to miss this. Make sure you're signed up to our newsletter, graycapitalllc.com/newsletter. Subscribe to the Gray Capital YouTube channel. All right, let's get into it. Welcome back to the Gray Report.
Hello.
Matt.
Welcome back, Spencer.
Thank you. Matt did a great job. It was man in the ship, man in the com last week. You and Addison, you guys crushed it. It was great. You know,
we were on the edge.
You pushed it right up to the line.
That's right.
But you were right there at the line. It was great. You know, it's always I wouldn't say I'm nervous. Like you know this is gonna happen. You know, you and Addison, you guys know what you're talking about. Know your stuff. But it's still, you know, I see the office antics sometimes. So I get a little.
It wouldn't have been fun if it wasn't a little scary.
There
was a couple times where we talked about getting fired.
Yeah, hey, good, perfect. But no, you guys did a really good job. If you didn't watch last week's episode of the Gray Report, check it out. Madison Lubert is our senior acquisitions and asset analyst here at Gray Capital. A little bit of a younger guy, but very smart and mature for his years, I would say. Always has just an interesting perspective. I always kind of pick his brain on the whole,
totally,
you know, the Gen Z mindset and what's going on.
Yeah.
So really, really fascinating. So yeah, check that out. And again, make sure you're signed up for the newsletter because not only will we be sending you the articles that we're talking about today, but a lot more. We send, you know, market updates. And it's one of the most well circulated newsletters. Focusing on commercial real estate and especially multifamily. And we're also going to be adding links to the reports that we release. We released a blockbuster report on loan maturities and potential distress in the multifamily market last month, Matt. It's gotten a lot of attention. Again, I think Ken McElroy just made a whole YouTube video on the research that you put out. Grant Cardone is interested. He's reached out wanting more information, which is
interesting. Markets here.
It's definitely part of the conversation. It's been picked up by quite a few different sources. And you've got another report that's coming out soon. I think it's going to come out before the next CPI print. Before we get into today's reports, I know I'm putting you on the spot a little bit, but you know, can you give us any insight into this latest report? Because the last one, you know, again, really, you know, sent out some shockwaves.
Yeah, and I think that viewers of the Gray Report will kind of, or maybe remember, at least I do, you know, for the past year, I've been tracking these monthly rent growth reports.
Yeah.
And at a certain point last year, and we've been doing that for like 2 or 3 years, ever since the beginning of the newsletter. But specifically, like, you know, it was about last year, I started just gathering up all of the rent growth, all of the, you know, places like Zumper, or Redfin or Zillow, Yardi Matrix. There's just like 8 private rent growth trackers. We want to get a good average on it, and we want to be able to tell which is from which. There's so much data.
Yeah, because what's the difference? Growth. I mean, you see, you know, two or three different sources. You'll get 2 or 3 different numbers, and sometimes they can be wildly different. I mean, one's positive, one's negative. And so, you know, what's their methodology? What's the difference? And what is that? You know, that aggregate. And we talk about this a lot, Matt, of, you know, kind of the 538, which, you know, if you're not familiar, you know, the 538 blog, you know, it kind of puts all the different you know, different political polls together and averages them and gives you the 538 average. You know, Real Clear Politics kind of does the same thing. And you're kind of just, you know, taking the average of the average and just like, you know, just good for statistical purposes, you know, where things are, because maybe it'll paint, it's a different insight. It's a different metric. There could be one that's absolutely the best and the average is kind of, you know, shading, you know, the reality, but I think it's still a good metric and understanding what those sources are coming from. But then, so other than just the average, we're looking at any key takeaways, any glimpses in the future, which I know we kind of try to steer away from, of a lot of like forecasting and speculating, but any insights as you're looking at this?
So in this, it gets into, and this is great setup because it gets into, this was a discussion we just had yesterday about rent growth and the kind of conclusions that we could draw from this report that we're working on right now. And it kind of ties into some of the economic discussions that I was having with Addison last week. Is, there's more signs for optimism in when it comes to the job market and this connection. So what we were talking about yesterday was this connection between the job market and rents. And my whole, I guess the thought experiment is, what if rent growth was supposed to go lower and it didn't? And what is making rent growth as stable as it was, instead of just fall, because rent growth spiked up so much, never.
What's the hot air? What's keeping rents elevated? Because we were talking about yesterday in that we saw some rent declines, nationally, kind of end of last year and through the first quarter of 23. It's picked up a little bit, but we saw some support. Now there's some seasonality, so it's like things would pick up, but with all of the supply that's come online, just the thought that the housing market and demand for real estate, interest rates rising, which should affect the job market, but it hasn't really affected the job market. Unemployment's still in record lows, and while we saw some slowdown from rents off of the unprecedented amount of growth, your point yesterday is that we saw 15-20+% rent growth in many markets. Just looking at the laws of averages and physics and cycles, we should see some correction. It doesn't have to completely revert to the mean, but there should be some snapback a little bit. And it's still, growth over time. I mean, from 2020, if the rents were, $1,200, they increased to $2,000. Now they've come back to $1,900. Well, they're still up a lot.
Exactly.
And so, but you're saying the recipe was there for rents to decline much further, and it's all connected to we're seeing employment being strong and all of these recession calls that have been missed. I mean, it's like, why we thought we were going to have a recession by now. But is it too soon to declare victory?
But
because we've been talking about this and looking at some of the catalysts for potential recession, it wouldn't be until October or Q4. So I feel as though there's a lot of things to be excited about, and there's a lot of reasons for optimism. But there's like the wave is still approaching, and we, again, this is the report that we put out. You can find at greatcapitalllc.com/report. It details the potential risk that upcoming loan maturities could bring some distress into the multifamily market. And we said, the loan volumes, the maturities are really low in the summer, and then all of a sudden they spike to $4 billion in October, just on the CMBS side.
And that number has not changed from the projections that were from the data.
Well, that makes sense. So there's a lot of reason for optimism, and it's incredible. So get back to rents.
So we're in this situation where, if anything, there is this connection between the cautious optimism of the job market and their continued strength, and it is, I think, supporting rents. Rents have all these reasons that they could have gone down. One is it just kind of the simple correction from the biggest raise in rents, the biggest change in rents in history. The rise in rents lasted about it was about 10 to 11 months. So from February 21 to December 21 was the run up, and then from that peak to now is the run down, which is about twice as long as the run up. And usually the reverse is true. The rise is gradual and the drop is, so everything is all weird.
Well, but we had the rise. That's true. But the rise had been occurring since like 2010 or so. We hadn't seen any declines really. It was just, much slower growth, 2 to 4 or 5%, 3%.
So that was previous to the pandemic.
Yeah. And so but that's how usually the market, it's like slow, 3 to 5, 2 to 5% growth, slow over 10, 15 years or so. Then maybe a recession happens, and it's a quick spike down.
Just kind of like the
usually
job
6 months. Yeah, exactly. Just similar to the job market. it's very much obviously related.
Yeah.
If a job can't pay rent, it goes down 6 to 18 months, usually rents. Rarely it gets to 18 months, and then, gradually starts to come back. It typically the year after, it spikes back up, and a lot of times a lot of those losses are wiped out, after the first year. So it's like you kind of get, 3% growth over, or, you get 0 over 2 years instead of the negative, and then with some strong years, but then it kind of flattens out into the low growth again. But we had the low, slow, decent growth for a while, and then a huge spike.
Yeah.
And so, but then you would think that there would at least be the big spike down from just the slow growth, but even more from the incredible run up. Yeah. But that's not the case. And so
it's so weird how flip-flopped it is, because usually you'll see the drop is about twice as big as the rise up. So there's a drop, and then there's a reactionary halfway up. You get a reactionary kind of reversion to the mean. But this time the drop was 4 times smaller than the rise, and so you're so in uncharted water.
So it's either two things. It's either, wow, there is so much rental demand, which I think is the case, or there's the macroeconomic events, for the correction have yet to occur. But that doesn't really track with normally how the cycle goes. But there's nothing kind of normal about this. Yeah, and we're sort of talking about very much correlated but sort of unrelated, triggers also. It's not necessarily the job losses themselves are going to, manifest themselves. Yeah. It would occur from, full circle, possibly commercial real estate going into distress. And there's be crisis in the, the financial markets and the bond markets.
And that totally jives with what we were kind of talking yesterday, Addison and I, or last week, about like we're looking for and we even talked about we're looking for the linchpins, and it may not be, it may be a case of, a broader vulnerability in the market caused by higher interest rates, or just the broader performance of the economy. Yeah. And in this case, it seems to be going better than expected, which is kind of
and there's been plenty of things to point to that would cause unemployment to go up. I mean, again, like where we've raised interest rates, those effects are still working their way through the economy, but still. And so it's like, why we've been surprised before, why can't we be surprised again? Yeah. But at the same time, we also shouldn't fall into a false sense of security of like, you always say that it's something bad's going to happen, so it never will.
So, and that's what I want to say too. Like when I said like, so we can't predict we're not out of the woods completely, and I wouldn't predict 100% safety, but I am saying as a description of the things that have happened thus far in 2023, I think it explains, what explains the fact that we haven't that rents haven't dropped more sharply than expected, and maybe what explains the fact that jobs haven't shrunk down because of interest rates is this kind of similar. There's a strength and a lot more activity going on in the economy than one might think post this downturn.
Well, and if I remember to the beginning of the year, a lot of the calls for the year, which were kind of cheap calls. I mean, that's the right term, but they're all basically all for 3%. Because no one knew, and so like, it's going to be 3% growth normal year. Yeah. And whether that means negative growth for the first negative growth that we have for the first half or the first quarter, and then we have growth throughout the remainder. But where are we so far this year?
And I was looking up, Apartment List has a pretty decent rundown of the month over month.
I mean, we can do that later. I don't mean to.
Oh no, it's fine.
There are good reports to go.
Exactly what I was thinking about last night is how much has it changed? Because yes, we are largely in the negative when it comes to year over year. But
as a nation,
but that is, that can be explained by the second half of 2022, all of the monthly, we were getting declining monthly rent growth. So, but in 2023, we have had positive monthly rent growth for each and every month of 2023, or at least a trend upwards for about every month. The thing is, it just hasn't been as strong as it was in past years. Yeah. What I wonder is, so now we're entering into, we're still in the summer, but I can't help think about the winter and the exit of the typical renter and then peak leasing season. Yeah. I wonder if it will still, if rent growth will still be relatively strong, if we will fight against some of the seasonality just because of the kind of weird, maybe the weird state that the market is in right now.
It feels like we're trying to work ourselves back to normal though.
Yeah.
And there's enough, like drivers, such as like, school year, school starts.
Yeah.
And that's starting. And so, we should see things really be cool. They will have already started cooling down.
Yeah. Like there are effects. Like I wouldn't say it would be hard to predict bigger rent growth in the latter half than there was in the first half. But it is funny because that's what a lot of the predictions at the beginning of the year thought that we'd get better.
They thought we were going to have a recession in Q1 or Q2 this year.
Yeah. And then they was like,
okay, grow with that.
But that really hasn't happened. I wonder. But ultimately, it's and some of the reports we'll talk about this. It's a very much a regional thing. We're talking about national things if we're talking about job market and national average rent growth. But one big factor in rent growth period is the amount of new supply has been at or near record levels. And
that's a great point. I mean, because if we didn't have the new supply, you could easily argue, especially nationally, that we'd be in very positive rent growth territory. But we're absorbing a lot of units right now, an incredible amount.
Yeah. So resilience, is, despite a lot of factors that could bring things down, that's true for the job market. It's true for the housing market.
So it's really, we're really not talking anything. We are talking about real estate, but relative to how they were financed, potential catalysts. But in terms of the fundamentals and demand, like if we're just honing in on that, and sound like a broken record, but the fundamentals look really good. Like there's really no real weak spots, that we're seeing right now. I mean, I think again, if we see a major hit to employment, but just looking at some of the the sentiment surveys, I know you and Addison were looking at. And looking at some of the wage data, I mean, wages are still growing. People are, employed if you want a job. Yeah. So a lot of that, which is really good for housing. Now it's difficult on the for sale side, but even that has been incredibly shocking, and surprising. And that goes to show just what the demand for housing is, where housing formation is. And I mean, we talked about this yesterday, Matt, privately. Housing demand is housing demand.
Yeah.
For sale, for rent, people need shelter. I demand shelter. Now, they're on the margins. It's some more people renting, more people buying, what they can do, what's more expensive, what's where the value. But we saw it during the pandemic. Yeah. When all the stories, all the demand for sale housing, everyone was buying a house because money was free. Like when the housing market was on fire, you could have made the conclusion or the hypothesis that we would see weak rental demand, especially in luxury assets, because everyone was leaving to buy a house. Yeah. That was not the case at all. There was so much demand everywhere. Now, we did have people who were like, I'm building or I'm buying, but I can't move in for 6 months, so I need a nice rent. We had all those new leases. We had more new leases that we were 100% occupied. So it shows what that demand for household formation is. Millennials are getting together, forming households, view that still their parents are finally getting out. You'd think that some people would be moving in together. Yeah. But we're signing leases.
Yeah, that is interesting. If you want to pull up, let's this market for CoreLogic said they have reported that home prices nationwide, including distressed sales, increased year over year by 1.6% in June 2023. On a month over month, they've increased by 0.5. So we're, at or near negative for home prices, but we're positive, and their forecast is even more positive growth in the future. What's interesting here is the regional variability. They have a map here of home prices in the United States. And it's a kind of a state by state, and it looks very similar to the kind of rent growth map. If you were to say, the Midwest is doing very well. The Northeast is doing pretty well. There is some strength in like Florida and South Florida, but places in the West are not doing as well.
I noticed, man, not on this report. Maybe I think you had it on the newsletter. You have to sign up for greatcapitalllc.com/newsletter. But a handful of Indiana markets, specifically Lafayette, Indiana, was named one of like the hottest housing markets. Yeah. More upcoming hottest housing markets in the nation.
I saw that same thing. Yeah, I think Fort Wayne may be in there too.
Yeah, I think so.
But it's of a piece. There are so many of these Midwestern markets are doing so much better than other markets, and it's hard to find one that's doing poorly. Even Minneapolis, which is perennially lagging behind, it's showing more positive growth.
It's needed. Why is that, Matt? Why is the Midwest? Why are we seeing this demand for housing in the Midwest? I thought everyone was moving down to the Florida and Sun Belt.
Well, I think part of it's affordability. The rent to income ratios in the Midwest are a lot lower. You're not paying as much in rent. And in the base price of rent is lower in the Midwest, but ultimately it's really about supply. It's the builders, they're subject to the same trends, and maybe not the exact same, but they want to go and build in the high population growth places, the popular markets of the Sun Belt. And they were making these decisions to build 2 years ago and starting their projects, so they didn't really know what was going to happen in 2 years. But it's, I keep thinking back to, when I started out, our chief investment officer, Jay Reeder, is talking about how student housing goes in cycles, and how they'll go into one campus, they'll build a lot, and they'll go to another campus. But I think that could be largely apartments in general. There is a lot of cycles where they build a lot here, then they kind of die.
Somebody reads a rent report, some report, and everyone reads the same thing. We had a meeting yesterday with a big institutional investor, made almost $100 billion in assets, all over the world, and it was really interesting talking to them about, they like the Midwest, but they're heavily invested in the Sun Belt and getting their perspective. And it's one, they've come to the conclusion now that we've kind of been talking about for a while, is that, the Sun Belt, there's a great story there. Everyone heard the story, and everyone bought into it. And so it was, you can overplay something, you can overprice something. It can be a crowded play. And that's what's happened, at least in the short term. I think the long term, looking at it, not having a lot of assets, in the Sun Belt, the long term, the migration story is there, and they're going to be fine. It's going to get absorbed, but you're going to have these periods, and you're going through one right now where everybody had the same idea to go build in the Sun Belt, and like literally at the same time.
Yeah.
And there are other markets that have not as sexy and just different stories.
Yeah.
And it took a little bit of time, and you would have to want to look into it. Yeah. But most folks kind of, I think, pressed the easy button in their market analysis and went with the safe stories that they could tell of, hey, everyone's moving to the Sun Belt, warm weather, makes sense, people retiring. All that makes sense.
Yeah.
But they didn't go to look, they didn't think to look elsewhere. And, the Midwest is, it's an afterthought, just being honest to folks on the coasts and elsewhere, Indiana, Ohio, into, there are places that they've driven through maybe or flown over. But I mean, the farther out you go, I mean, people are like, what do people do there? They don't know what they don't know what even goes on here, or the people that are here. And so
there are some people that are like gateway I only invest in gateway markets. I'll only invest in New York, let alone,
And it's I've noticed that it's when people have the least information or less information, they make those decisions based on, it's big enough, and, can't go wrong with New York City or Washington, D.C. because it's the nation's capital, or Miami because that's what I'm familiar with. And everyone, I'm a Central South American investor. I'm familiar with Miami, or I'm familiar with Los Angeles. Maybe I've heard of Dallas to an international investor would be not tertiary, but they'd be, Texas, you're really going out there, and Dallas is a massive market, so it's what are the big markets that they're familiar with that they think that's a sure bet in an American city. So San Francisco makes sense, Los Angeles makes sense, New York City makes sense, and you see that on the coasts too. They're I don't have the time. I don't know what happens there in the Midwest, but I've heard Atlanta is good.
Yeah.
And markets around there, it's warm. Let's do that. And
or Tampa, they got a beach, they got vacations. It seems like a nice place to live. Palm trees. What do we got? We got maple trees.
Yeah.
They got winter. We have winter.
Yeah, with a lot of row crops, corn, soybeans,
but
raisins.
We have people that live
great
here.
business. Well, we got great business environment. That's a lot of growing markets. A lot of great business environment, a lot of businesses, great place to live. It's affordable. But either way, you don't want to. You have to be careful doing the thing that everyone has been doing.
Yeah.
And right now, like as an investor in Indianapolis, heavily allocated to Indianapolis in the Midwest, and I think there's still a lot of runway because we're still way undersupplied. But things have gotten pricier in Indy, and I'm like, I'm not going to the Sun Belt right now, but I think there could maybe be some opportunities as we see that snapback in the Sun Belt, and it's see what everybody's doing. You don't always just do the opposite.
Yeah.
But sometimes if everyone's moving in one direction, it's worth looking elsewhere to see, is there anything else going on?
Yeah.
Because where everyone else is going, that patch, that fishing spot gets over, it's got all the structure. It should be good. And you've caught fish there before, but man, it's been overfished.
Yeah.
There's other place to catch fish.
Yeah.
You don't need to catch every fish over there. So like, what's the goal? Let's find the best way to achieve our goal of, returns to investors. And achieving our business plan or whatever. So
no, I think I totally agree. And especially, there are, when we will discuss this just a little bit, there are some signs that certain Sunbelt markets are improving a lot more than others. Well, and I always like, Miami is just this exception of any kind of Sunbelt narrative of cooling off. It is, the home prices are up and rents are up there. So that's really interesting. But these top markets at risk of decline, there are plenty of nearby ones. Fort Myers, which is like Tampa.
Well, it's interesting. I mean, a bunch of Florida and, Mountain West and, coastals, that's not really coastal, but Washington, Spokane. Yeah. Interesting. Provo, Utah.
And these are the places where, the kind of remote working hotspots. I want to live in a place.
Good point. Yeah, Provo, Spokane,
natural amenities.
Yeah,
and now these are at risk of home decline.
And that's 100% what this is.
Yeah,
yeah.
I wonder,
I'm going away,
like Asheville or just these areas where it was nice, but now maybe you gotta go back to the office. I don't know.
But, Matt, White House.
Yes.
News. Unfortunately, man, I've got a hard stop ad coming up.
Okay.
Unfortunately.
Well, don't worry, because there's not a whole lot. I mean, there is.
Yes, no, you got to stick around, Matt. There's going to be so much that's going to be jam-packed. So, like, you're going to have to stick around to the whole episode. So the White House, the Biden-Harris administration announces actions to lower housing costs and boost supply with the stroke of the pen. Matt, what? I'm skeptical. Are we doing anything here? Is it good?
Well, it's not
changes.
It's not too radical. As much.
They've made a lot of statements about housing.
That's
what has been done about housing.
This continues the efforts, plans, announcements, messages, missives, memos.
That's exactly what it says.
There's guidance too.
No,
but they have been, talking about this a long time, and even in the very early stages, I said it's worth watching this because it could have teeth and it could move things in a way that maybe a local government couldn't, but in
what sources? Oh, they're using the Fed sources.
But I do think it is, it's worth just signaling, all right, this is the direction. So this is something that you might be able to expect. And the three things they signal out are reducing barriers to build housing, like restrictive and costly land use and zoning rules. The second is expanding financing for affordable, energy efficient and resilient housing. And then the third is promoting commercial to residential conversion opportunities, particularly for affordable and zero emissions housing. Now, to go back to that.
Can I stop you?
Yeah,
I mean, we're going to talk about it, Matt, but like, if again, like because we've dug into this, this is for me, like, this is evidence that like of how serious or non-serious this plan is, because we all know how a drop in the bucket that these conversions could make. And so if this is the third leg of the strategy for housing, I don't have a lot of faith in the rest of it, Matt, but
I almost brought a bucket to this and tried to get an eyedropper and then and drop us like, this is what it means.
Just don't even do,
because they were kind of bragging about having converted 1,000 units from office to residential or some other thing to residential. So 1,000 units were added, which is that's 1,000. That's not that much in the scheme of things. And the fact that the White House
across the United States
is like, that's crazy that they wrote that down. It's like, I bought a house yesterday. It was my cat's birthday yesterday. That's the kind of importance.
You reach out for comment?
No, and I also don't have a cat, but But I will reach out for comment, and I hope they get back to me. Fannie
What
Mae
is
did.
answer me this, Matt.
Yes.
Press briefing.
Yeah. Mm-hmm.
Relative to the Gray Report and Gray Report listeners, like, will you have to like fill out a contact form? How do we get into the briefing room?
That's a good point. I will chase that down, and if I don't have a little lanyard and a little label, and I'll be raising my.
I mean, some of those guys. I mean, they've got some pretty obscure outlets in there,
Right.
and I
They
think
just fill out the right paperwork. So
yeah, I think that we've got a lot more legitimacy than some of these outlets. I mean, we're the leading source of commercial real estate.
we can be friendly.
Yeah,
I don't have to be a jerk in there.
No, I know. You'd be. I have no doubt that you'd be incredibly cordial. That's why I'm bringing it up. So anyway, we'll
Yes.
give an update when the White House has reached back.
Yeah, because and then along with those 1,000 units, they're also announced new funding to produce research on office to residential conversions, including producing a new guide for policymakers.
Oh, the White House is going to put a guide together?
That's right.
Or is it HUD's going to put it together?
Well, yeah, I think HUD's doing it. But that's the material, the deliverable really is a guide for this. But there were other things like a $27 billion greenhouse gas reduction fund, which will provide financing for thousands of clean energy projects. So, funding, green buildings or what have you. But I do think that this other part, this HUD announced new guidelines that increase the dollar amount threshold at which a multifamily loan is considered a large loan and is subject to additional underwriting requirements. So they raised that from 75 million to 120 million.
Ding, ding. That actually is very interesting, Matt. And of all, jokes aside,
that's the circle. I'm circling that.
If you are an apartment investor or multifamily, syndicator, that's something to be paying attention to.
Yeah.
Maybe you're not doing deals that big, but this is important. We've run into this a handful of times in some of our bigger deals when we were going the HUD route. Well, obviously, not all the details are here. I guess we can read some of the headlines. Guidelines. But a lot of it comes to there's a they bundle these loans together, these Ginnie Mae loans, which are used to finance at least the HUD deals that I'm familiar with. Yeah, the 223Fs. There's a lot of different types of HUD loans. But sometimes, they put them, they batch them together into these blocks, and if a deal is too big, it kind of like doesn't fit in.
Okay.
And so it can be hard to to securitize it all.
Oh, interesting.
And so I don't know if that has something to do with it. Because you'd think that usually the deal gets bigger, it's easier to underwrite.
Yeah.
Which is, I guess, a little counterintuitive because you think it's more money, but this is really great because there's most assets are not going to fall into this category.
But I bet it has a knock-on effect if certain players are not subject to these underwriting requirements in certain situations that may change the kind of deals that they go after or the ways that they do business, that could affect people pursuing smaller deals.
Yeah.
I could see that. And, if it does have the intended effect of encouraging more housing, which is all of this is to the point of this is to build more housing. So
taking down the barriers, and it's like, hey, I'm going to do a big development, and they're like, oh, you're going to build how much housing? No, let's do it. All of a sudden, you're encouraging smaller developments.
Yeah,
which, I just like them to get out of the way in general. But
yeah,
but if they are guaranteeing this very fancy debt that makes it the most accretive, it's a double-edged sword. I think that a lot of operators have mixed emotions on kind of getting in bed, working with the government, in terms of the debt, but it also makes the multifamily sector that much more attractive because you do have this government insured, essentially backed financing that is more readily available, is much more consistent. It makes it a great asset class. But you're also, anytime you're dealing with the federal government, administrations can change, opinions can change, and rules, regulations can be changed by fiat.
That's a good point. Yeah.
And having such a large market share, they can really move things. Right now, between agencies, different types of FHA loan programs, so it's Fannie, Freddie, HUD, makes up more than 50% of the multifamily debt space. So, which again, it's great, but you get what you pay for.
Yeah, and I think a little bit has insulated it from, in a way that office is a little less insulated, well, for its own reasons.
Yeah, no, for sure. Yeah, well, offices on all, floating rate, shorter term, higher rates. Yeah,
Yep.
sorry.
No.
All right. Anything else, Matt, on the White House?
No, well, and I think what you said about the kind of transience of administrations, and the fact that this has taken 2 years to get here, it does. So take this with a little grain of salt.
Yeah.
But this is a trajectory, so we could see more bigger actions in the future. But I think the most important material takeaway was this new guidelines that increase the dollar amount threshold for large loans.
Awesome.
Makes it a little easier. So
yeah.
That's great.
Okay, Matt, easy transition.
Yeah.
Converting office and retail to affordable housing may soon be easier. This is good. This contradicts what we were just saying. We're like, this is crazy, but is it going to be easier according to Globe Street?
Well, okay. So full disclosure, this is a kind of a sponsored piece, or it is one where, the Globe Street will take in.
Presented by Partner Engineering and Science Inc.
Exactly. So it's not like written report, but there's good stuff in it. And it's very interesting because the headline doesn't really align specifically with the content of the article. Ooh. By the end of the article, you realize maybe it's not so easy. But it does.
It's one of those where the headline is exactly the opposite of the article.
Yeah. Well, it will leave you to be the judge, but I agree. I think so. The one thing they do, and they kind of front loaded it, they talk about the legislation that's being passed, and they don't reference. I think this was probably written before the White House's message, but they do reference a couple of California policies and bills that are being discussed. One is going to help zoning, and one's going to help office to retail or office and retail to office. Residential conversions.
Mm-hmm.
So you got those.
The retail to multifamily is are they talking about like malls maybe?
Yeah, I know.
There's like maybe retail is not good also. So let's maybe put it in the mix.
Yeah. You put it in a strip mall or something. I'm not sure how retail would work. And I said this before. Is like it's structurally different. You say someone's built different. That means that it's going to take a long time to you got to fundamentally change something.
Yeah.
I also was thinking about like, okay, so let's say that you have a herd of cows and people really want horses. You need a horse to ride. Well, you can ride the cow, but it's still going to be a cow. That office building's still going to be
square peg and round hole.
Yeah. You can fit a person in it, but there are
the strip mall. I mean, can you turn those into livable residential?
Sure, you can ride a cow.
Yeah. People do it.
Yeah.
Do you want to? Is it the highest and best use?
Yes,
of the cow
to
people around, or is it milk and meat production?
Yep. Sometimes you got to come down, got to grow something else. I'm stretching this metaphor.
No, Pete, sometimes you do, and with real estate, and if you ever renovated a home,
mm-hmm.
There's always there's a lot of reasons to keep things and not to throw, good out with the bad and like,
mm-hmm.
hey, we don't need to tear this down. We can fix this. But sometimes when you get into it, you quickly realize, no, we do just need to tear all this down. Again, we live. We work, you can see, this isn't a background. This is, you can see part of our office here. We're in a, 100-year-old, building that was an old box factory. And that's what this building is called. It's called Box Factory, and it's been reconverted to offices. And it makes a lot of sense.
Yeah.
Now it's sat vacant for many decades.
Yeah.
So it's not that these conversions aren't possible. They can't do that. This only could have been done with a lot of subsidies, though.
Well, I was just going to say too, because talking with some, in discussions about like the story of how this got converted into offices, it wasn't easy either. Because they had to work around, was there like historic preservation kind of things? And so even just
adaptive reuse. Yeah, the way they got their equity financing and
but like
I don't know the full capital stack story, but I know that. Yeah,
regardless of whatever it is, when you're converting something, it's a lot. You're working around something that is in place for a completely different purpose, and it's a lot. You can just feel how constrained it's got to be. If you're working with something that you just can't design from the ground up, Now, just to kind of return back to the Globe Street article, yes, they do talk about those legislations, things that are making it easy on the zoning level and on the kind of structural regulation. I don't know what the specifics are, but I keep thinking about that Charlie Munger designed UC Berkeley dorm that was like, it's like Zilla, like
no windows.
Yeah, all you need is no windows.
And just be studying.
And then I read there was a as I was looking into it, there was one in Michigan that actually did get built, and and it had some windowless units, and grad students were like, yeah, I guess it was fine. I mean, I just live there, and you don't really notice it, but I have a feeling it's going to make them less, not as marketable. But again, I don't know what regulations they're going to ease. But one zoning, one site.
So you're saying they're really not addressing the real like problems of doing this. It's more of saying we're going to make it a little bit easier on like the margins. We're going to clear up some red tape, get some incentives, but like
when it comes to actually doing the thing, which is what the Globe Street article, the bulk of it is about. It leads with this legislation, but it then also says like, okay, so let's say you want to convert an office you've got to do feasibility studies. You've got to do all of these things even before you start the project. You could do a feasibility study and say, it doesn't make sense.
Yeah.
And but things like traffic, where the water's going to flow, where all the kind of utilities are maybe coming from, and then the impact on the neighborhood, and you've got to get a lot of things right just to convert something, and then pile that onto the actual building, transforming it. There's a lot of serious hurdles, and one of which is like maybe the locals don't agree with it.
Yeah, I think it's the bulldozer outside.
Yeah. Okay, we feel in our office structure, we are feeling a vibration coming from the construction that is ongoing, as they're building a parking lot next door.
That's from.
Yeah, I think so. But anyways, so there's all this stuff, and there is a clear attention. But I think that it is a little bit misplaced. It's exciting to think about, reusing and office. The decline of the office is in so many people's minds. But it would be probably more effective to think of these empty office towers as available land for use rather than available buildings to be converted.
I think that's a great point, and we don't need to force things that like aren't good solutions either. If it's going to be easier and better to just build new, then let's just do that.
Yeah.
And then maybe the housing market, the office market recovers, maybe, or they're reduced, they're adapted to be used in a different way. But, I don't think, the California legislature or the Biden-Harris administration knows what should be done.
I was going to say,
how do they know?
I was going to say that too, is like, even if they clear all these regulations out, even if they make it so that you can
just do it,
windowless rooms, like they're going to have to subsidy a lot of it. Like it still doesn't make economic sense to convert a lot of these.
If it doesn't pencil, why are we incentivizing this type of malinvestment when that investment could have gone into other housing? That's the thing. It's like you're not going to.
Yeah. So, and I think it does kind of essentially boil down to like a kind of nostalgia that you want to keep that building in place, and it just seems so wrong to wreck something and build something. It's such a waste.
And I think there's like a merit to that up to a point, and there probably is a role for I think cities to earmark some buildings, and I don't think the city should be buying up buildings either. I don't think that they should be in the business of real estate development. But if they want to create a TIF district or find some other incentives to be like, hey, we really want this to be done, we'll give some tax credits to do it. I mean, that's fine. But I think if the people who don't understand the business are creating the incentives to something that isn't necessarily what like the market is really screaming for. It's certainly a problem. What are we going to do with these buildings? But let's just not just jump at the first opinion that someone throws out there that isn't necessarily like read in on the subject. Because I always get asked this by people who aren't like involved in real estate or aren't involved in commercial real estate. It's always and it makes a ton of sense. Got office buildings that aren't being used. We need more housing. Yeah. Well, why don't we just turn the office buildings into housing? Like. Simple as that. Right there. Simple as that. It's like it's like saying we've got a lot of planes. Why can't we go to space or I don't know.
Yeah.
I don't know.
I like my cow that you ride on.
Yeah. I'll just,
We got all those cows. We can ride a cow.
I don't know why I deviated. I should have just stood firm at the square peg ring bowl. And I should have taken heed from your cow horse analogy, but
But yeah, ultimately, and we said this too, is even if they converted all of the available vacant offices, it still wouldn't do much of you get a couple % increase in inventory.
And again, just the fact that this was like the third leg of the Biden-Harris administration, like housing plan stool is, and we always, Matt, every time that they put these out, it seems like they're like, hey guys, like, people keep asking us about housing. We need to put out something. They keep putting these they keep like putting out these like plans and memos,
progress report,
and progress report. And I guess some changes are being done here or there, but it really seems like it's primarily lip service.
I think they are spending $860,000 to determine if office to residential conversions work. I think that's what they're funding their research on.
Yeah.
We'll see.
It either works or
they could pay up. They could pay.
Is that the job?
I know.
Is that the job to do the feasibility stuff?
Doesn't work.
Yeah. How do we sign up? How do we sign up for the research arm? Who else? Who are they hiring?
I'll put that in my email.
The Urban Land Institute.
I'll contact them. I'll include it in.
Actually, he would probably need somebody they can hire.
Yeah.
Okay, Matt. Real page. Stellar second quarter apartment demand in key markets.
Yeah. So this is the start. There's a couple Real Page articles that I wanted to highlight in this video. The first is about apartment demand in key markets, not nationwide. However, this Berkadia report did note that there was some positive demand in 2023. However, the bulk of the demand are it's regional variation. Now I think this might support the idea that apartment rent growth essentially deflected. Like we kind of deflected a rent implosion. But if demand is a leading indicator of rent growth, at least for these markets, which are Columbus, Atlanta, Kansas City, DC, Fort Worth, Seattle, Minneapolis, West Palm Beach, and Denver, for these markets, they saw demand that made up for a lot of the decreased demand in 2022.
Yeah. Wow. I mean, in the Midwest is showing up again, really strong, Matt. Yeah. Again, in taking 2 out of the top 3 spots for very strong demand for the second quarter. None of these markets really stand out as shocking, except not shocking. I think more of just we've been waiting for this is that a little bit of bounce back for Minneapolis, who has seen quite a few years of declines, stagnations, and not witnessing any of the growth or absorption that the rest of the nation saw during 2021. So it's got some catching up to do. So it's got to.
It makes a lot of sense for sure.
But so that's good to see.
Yeah, for the past 3 years, ever since we started tracking it, the outlier on the low end was always Minneapolis. It was never doing as well as anything else.
Minneapolis and San Francisco.
Yeah. And then the high end was always Miami. It's just always done great.
I think did Minneapolis did they hire back their police?
Oh,
maybe that's why.
We could make a political.
I do not good or bad. I think that whether it was perception is that Minneapolis was not a fun place to be during 2020, and it's amazing how big of an impact.
So could be said about,
or so if there are other drivers of why it just completely sank. Yeah, someone let me know.
It could be housing policies. Maybe the housing policies
they do have some. Are more definitely in San Francisco
and Minneapolis. Minneapolis.
Yeah. San Francisco makes a little bit more sense because everyone I think knows kind of the story of San Francisco and just really going down the hill and the remote work, tech companies not doing as well. But Minneapolis, to me, has been a little bit more question of why it's done so poorly, other than like the Black Lives Matter riots and protests and just uncertainty.
Yeah, I would have to look into and see what their housing policy is, but it is a rare exception to the general trend of the Midwest, which has been kind of resilience and strength. But in addition to yes, those individual markets are doing great, but the idea that there is this variability is, you point to that's immediately apparent. Some markets are having a lot are having a lot of rent growth. Some markets are having a little bit. And Jay Parsons wrote about this. He kind of said as much this morning, and is like, okay, gravity exists. Supply. What I like this. Build more. Rents grow less. Build less. Rents grow more. Like, that's my favorite. It's like when Addison said, cap rates go down, prices go up.
Yeah.
But sometimes
Same with bond prices and yields.
Yeah. You sometimes need to repeat this because it wasn't necessarily true. For the, a year and a half ago, it wasn't necessarily true. They were pouring more supply into Sunbelt markets, but rents kept going up. And we said that at the beginning of this year, this is the year where we're starting to see supply actually matter. And that's what's behind a lot of this variability. And he says it very specifically, submarkets expanding their apartment stock by over 10%, cut rents nearly 2%. Submarkets adding 5 to 10% more units, cut rents by about 0.5 units. On the other hand, submarkets that added less than 1% new units increased rents by nearly 3%. You can see that on that submarket level, but there's also, in this rent growth report that I've been doing, one of our, we've singled out a bunch of markets, and one of the key patterns alongside, I think, affordability was the amount of supply that were, the completions as a percentage of current inventory is like a key factor if you're going to look at supply, because otherwise Dallas-Fort Worth gets everything.
Yeah, there's a lot of variables that go into demand and rent growth and all of that, but I like how Jay Parsons has, like, let's just boil it down.
Yeah.
Like, more of something, if there's demand for the thing, and then there's how many things there are, and those two line up, and if there's more of the thing than there is people wanting the thing, then the price goes down for the thing.
Yeah. I do. And just to continue, and this is a little bit off of the demand, but he says that one modest surprise right now is how much new supply is impacting Class B in high supply submarkets. Despite a massive rent gap, some people are moving from Class B to new Class A. But he's like, the speed it's happening is pretty notable. These renters are willing and able to pay more, and in turn that puts downward pressure not only on Class A but also on B and C, but only in those high supply areas.
Yeah, no, I think that's certainly true. People are definitely trying to move up. I mean, wages are doing well. I mean, people are employed, and then with all this new supply coming online, these developers, what we're seeing, and this comes back to the loan maturity report, Matt, that we put out, is that these projects were built on short-term construction loans, basically a bridge loan, and they're coming due, and they need to get this thing leased up as fast as possible. They need to get it stabilized so they can try to refinance it or sell it. And so they're releasing them up at lower rents than the market. And now maybe they're releasing them up at the rents that they pro formed a couple of years ago, and rents in the market have just have gone so much higher. They could, so for example, they could be charging for a 2-bedroom, let's say $2,000, but they pro formed it at $1,800. And, maybe the construction is a little bit more expensive. So let's say, the break even on all of that now, or the net is, $1,900 to kind of keep it their pro forma returns. They could get probably the $2,000, but they're going to charge the $1,900 to get it leased up as quickly as possible. And if I'm the B class renter and my rent has been increased by 15-20%, and I'm like, man, this place isn't even that nice, and now I'm paying like $1,600. I'm like, screw this. I've gotten a raise recently. I'm going to upgrade because I'm going to get something that's brand new, all the amenities, kid and caboodle, the whole thing. There's the value question there. You have to be asking yourselves, what you're charging, is there the right value proposition? Are your residents getting what they pay for relative to the market? And how much more do they have to spend to get something that much better?
Yeah, it is interesting how, because we were talking about this problem where you can't build an old Class B unit, and you're building, it's going to be usually Class A, unless it's like predetermined that you're kind of building
even if you're building affordable, typically, I mean, it's new. I mean, you can use cheaper materials, but it's still new. Even if it's still a laminate countertop, it's a new countertop, and most likely they're probably going to put a hard surface in, quartz, because why not? They've gotten the tax credits to do it. 9 times out of 10. The cabinets are already, even in a luxury apartment, you're putting in cheap cabinets that look nice.
Yeah.
But you're not putting in the most expensive cabinets. So the difference is it's not that much.
Yeah.
It
is just really interesting that there is some effect, because you'd think that there would be a big divergence as people could not afford Class A. It starts living up at a different place where people hit a ceiling for Class B, but if there is a high supply, it's a little bit more of a fuzzy, of some fuzziness between the population.
I think all this is a good reason for operators, especially property management companies. We're both of those things, and you can't take your residents for granted. Yeah. I think that it's been easy for operators in the last couple of years because we've been 99% occupancy. There's been nowhere else to go, because you can say like, look, you can go somewhere else, but you're paying a lot more. Yep. So people would stay. Now they've got more options. Renters have a lot more power, and it was never right. When that case when it was flipped, when the landlord had all the power, it wasn't right to say, to not treat people with respect and be like, take it or leave it.
Yeah.
And to take those residents for granted. We're a service business. You have to give people great experiences. That's what people are looking for.
Yeah.
And now when people are looking at the market and that there's more options that are nicer, they're looking at, how did that leasing agent, how did that property manager treat me?
Yeah.
Or, were they on their email to me?
Mm-hmm. And when there's new
were they
supply,
nice or not?
And if there's if there's an alternative, there's five new alternatives.
I'm going across the street.
Yeah.
I'm going across because they've got a concession. It's $100 different, and they've got this that you don't have, and it's newer, nicer. I've ever lived in it before.
For sure.
Like, it's going to smell like new paint rather than like whatever food the last resident was cooking.
Yeah. No, I agree. And that kind of leads us into a little bit of this next article. It kind of, both of these articles connect with Jay Parsons LinkedIn post. And he does say in that post, for investors and operators, if you're in high supply submarkets, the next 18 months will be a tough sled. There's ample demand, but even more supply. Starts are plunging, which is what this article is about. Starts are plunging, but should be set up. So that should be set up to have a strong rebound in 2025 or 26. The reality is, because we're never able to sustain ultra high supply, we'll likely see ultra high demand areas like the Sunbelt outperform in the long run, just like we said. So 18 months is what he's saying, is like this kind of oversupply timing.
So, every beginning of the year, there's always these like pipeline reports of how much supply is going to be delivered, and we always look at the number. At least last 2 years, I don't know if it's just post-pandemic supply chains, where it's like
it's always revised downward.
It's always revised downward.
Interestingly enough,
is that going to stop?
I think that RealPage revised theirs upwards.
Ooh.
And so, and it does make sense. Supply chains are easing a little bit. But what is interesting, but
we're still building a lot. We're still building a lot.
We're still building a lot.
So we're building a lot relative to history, but we still have a lot to build relative to further history.
Yes, exactly. There's a long ways to go, and that because interest rates are so high, we didn't get people aren't taking on new projects. So that's what that 18-month is going to happen. And we're going to get this shortfall. Regionality is what I wanted to. That was my big takeaway here, because if we're talking about supply, it's not the same. It's always going to change depending on where you live. And just this paragraph quote is the most useful here. Multifamily starts were only up in the South region from last year, with a moderate increase of 5.9% to 266,000 units. Starts plunged by 49% in the Northeast region to 39,000, and they went down by 25.8% in the Midwest to 47,000 units. And then the West region decreased by 14.5%. So these hot markets, there's still a little bit of building interest. They're the ones that didn't get that because they're in the Sun Belt, or the South, they call it. It actually increased.
Well, yeah, I mean, it's funny. We were just talking about this. It's the consensus. People aren't going to want to say that they were wrong. They're just going to say, there's a concentration right now, and it's going to even out over the next couple of years, which it probably will. But, we're still going to have these cycles of oversupply, and then
it's not going to take away the apartments either. Yeah.
Yeah.
And there is, if these things keep continuing, there is a risk that an apartment does get oversupplied. I don't know what
We're certainly a market. Yeah. No.
But I do think, and we mentioned this before, there are opportunity. There could easily be another rise in some of these Sunbelt markets that have seen such rent growth as the kind of cycle pulls through.
Yeah, absolutely. It's always an interesting 3, 6, 9, 18 months.
Yeah, for sure.
Matt, there's a Berkadia piece.
Yes. Okay.
Do you want to talk about the national multifamily?
Yeah, just really quick. Now, I do miss the methodological depth and real thought leadership in a way. Like, thought leadership's kind of a cliche, but when Jonathan Rappa and Noah Stone were helming the thought leadership at Berkadia, it really was like, these were some deep stuff.
It was a little bit different.
And like really genius level supports with some like methodological heft.
We're the only ones that
I loved it. I don't know. Maybe I feel like I liked the band before it was cool or something. It's like their early work was really great, but this stuff is still a little passable, maybe a little more mainstream. But if you want a real banger, multifamily return volatility and why it matters is a classic seminal work from 2021. Still holds up today. But to this mid-year report, some really, really great stuff in it. And I do like how they foreground the employment and job market, which is what we said, a lot of the apartment market is going to hinge on, or at least follows really closely correlated to the employment situation, whether it's people's expectations or just like how, the connection with housing in general. I also think it was interesting what they talked about demand and how the Phoenix apartment market has been on the leading edge of absorption, even as it is at the leading edge of this downswing in rent growth. They single out Phoenix, Houston, and DFW as our top markets for absorption. But that's the thing. It's like DFW is so huge. It's like 8 million MSA, and Houston's right up there too, 7 million in their MSA. Yeah. So they can have a big net absorption numbers. Yeah. But like if you're looking for like
all relative.
Yeah, it's all relative. I'd like to see a percentage and a proportion, but those places, it's just like pay attention. They've got submarkets just as big as some individual.
Yeah. Oh yeah,
so there's
for sure.
A bunch of
1.2 million units in the pipeline. Looks like.
Wow. That's a lot.
Now that pipeline could be over multiple years.
And so they say their projection for the end of 2023 is 502,000 deliveries, which is roughly around the same as RealPage's. And then their 2024 projection for deliveries is 656,000.
Wow.
Yeah.
So the pressure from the supply side is only going to be, that pressure is going to be increased next year.
Yeah, exactly. And it really behooves people to, because supply is local. You look at the market. If you are choosing to invest somewhere, you better look and see if your apartment, if the apartment property that is in a market that is getting that new supply or has recently got it, then that's something to think twice about. But it could be in a great submarket.
So maybe maybe on the Sunbelt you might not look until end of next year. Maybe rents are going to be lower.
Yeah,
and a lot of deliveries. Yeah, in a weak market, but it may be a better time to be picking up assets and keep picking up assets in the Midwest where it all makes sense still.
And this is a really great map here. It's kind of a color coded where it talks about the annual inventory change. And I feel like I'm beating a broken record, but it's the same color. It's the same map, basically. Now, it's like the housing market map.
Yeah.
The hot markets, or the markets with a little supply expected are in the Midwest and the Northeast. The apartments that are getting a lot of supply are in the Sun Belt and kind of the West. And those are the same markets where the housing market's actually cooling off too. I don't know why it's connected, but it's some connection.
Housing demand. Maybe capital runs around and he reads the same couple things, talks to the same people, and they all go to the same markets and they make all the same trades. So they all offload and off-source and delegate any thinking.
That's right. Well, and it speaks to perhaps like there are larger trends afoot than maybe, a specific, maybe there are larger trends that are shaping things rather than, yes, multifamily supplies a lot, but what's driving this influx of supply is the same thing that maybe has driven, the snapback.
Well, I mean, demand for multifamily investment. I mean, that's not just on the acquisition side, investors getting involved. That is institutions saying, wow, multifamily is we believe in it. It makes a ton of sense. We want to allocate a lot of serious money. And it's a lot of big institutions with a lot of money who are like, let's go in and okay, we'll do some ground up development. And then they're like, okay, well, welcome to multifamily investing. We'll get you signed up. Yeah. Have you heard of the Sun Belt? Yeah, I love it. I love Florida. People are moving there, nice and warm. Makes sense to me.
Yeah.
And, and so then but they don't go to the next couple slides where it's like supply, what are the true fundamentals?
Yeah.
Other than just being, it's fine. It's absorb because, look at all these jobs. We've got all these potential, corporate headquarters is going to come here. Maybe it happens, maybe it doesn't happen. It'll all be fine. And a lot of it will work out just fine, but it's not as clear of a picture.
That's a good point. I was talking about,
it's not as simple.
Yeah.
It's not as simple.
Because I was talking about these larger forces that are, but that's all fluff.
Yeah.
If you really want to nail things down, look at how many new apartments were built somewhere. That's going to get you it's going to go a long way to predicting how things might be for rent.
And just, looking at rent and occupancy, it's an interesting list, Matt. Different numbers from some of the other, like Yardi, but like year over year, top occupancy markets, Madison, Wisconsin, really strong occupancy. Got Northern New Jersey, New York, Milwaukee, Omaha, San Diego, West Michigan, Knoxville, Orange County, California, and Ventura, California. A little bit of mix all across the country, but not a ton of Sun Belt. Matt, is there any Sun Belt in there? San Diego is very sunny, so maybe that and take the California out. There's no Sun Belt. It's all north. It's all Northeast and Midwest, which is what you keep hearing of. Those are the regions that are seeing strength. Now, in terms of rent growth, topping the list is Knoxville, Smith, Tennessee, Madison, Wisconsin, Northern New Jersey, Cincinnati, Little Rock, El Paso, Louisville, Tallahassee, Indy, Omaha. Handful of Sun Belt, but man, again, the Midwest is really dominating this list. Guess Tennessee is Tennessee's Sun Belt technically. Knoxville.
Yeah, I think it's the Dixie State.
Yeah, definitely the South. But Madison, Cincinnati, Louisville, and Indy, and I don't know what you call it, Omaha, Nebraska. That's Midwest for sure.
Yeah,
it's further west than the Midwest.
Well represented, and it does seem like we've had our time in the sun. I
know. I'm trying to move on. Don't look over here. What we have going on in our markets. It is nice, and we are enjoying it quite well. Thank you. This is what's trading sales 2023 year to date. The volume 14.6 billion. That's the weak sauce, Matt. Those are weak numbers that we're putting up. Price per unit average 316,000. That figure is absolutely useless to most people because so many markets are different. We're talking difference between New York and Los Angeles and Little Rock, Arkansas. You're gonna have a little bit of different price per unit. Transactions 184. That seems weak. Is this just Berkadia's numbers?
These are Berkadia's numbers. I want you to look at what's.
Okay, sorry, Berkadia. I didn't mean to call it. It's
perhaps
everyone's down. It's everybody. It's weak sauce for the industry. It's weak sauce for us, Matt. It's weak sauce for every broker. Volumes are down 70 to 80% depending on who you talk to. Cap rate average 5.2, still too low. Better than 4.5 or wherever it was last year. 4.2. 4.5 is probably around the average. 5.2, you're getting close, but we're still looking at negative leverage environment relative to where interest rates are. Fixed rate financing today, you're looking at about 5.5% plus or minus ish, depending on terms and sponsor and leverage, all that stuff. So we got negative leverage on the average. Not good. To me, we still have a chunk to go in terms of cap rate expansion. There's been a couple articles, CBRE put one out basically saying that we were peaking on cap rate expansion.
Oh yeah.
I just think that is premature. Not could it be the case? I don't, no crystal ball, but I don't think so.
Yeah, I think
there's not. You need some spread. You need some spread. Usually we got 100 basis points of spread.
Because I think that if the cap rates really were where they should be, there'd be a lot more sales volume. And
People are ready to go. People are ready for good deals.
people are bringing things to market.
People are bringing things to market, and and this is how I know the brokers know because they're making up their pro formas and like making the numbers look like a 6 something cap.
Yeah,
it's not a 6 cap in reality, but like, and because they know that's where it needs to look. Where before they would just be like, it's a 5.5 cap. So it's a 5.5 cap on T3 on the T3, but it actually would be. But now they're like, it's a 6.5. Well, if all you have to do is do this and that and this and this and this, and then you get this and that and then that and this, and then in a couple months it's a 6.5 cap.
Yeah,
it's like, oh no, you're saying maybe
you find oil. Could find oil on the property. That would be great.
He just installed solar panels everywhere. You start renting scooters, and you just build back everything. It's like, and all of this is going to happen overnight. I was like, not realistic. So be careful out there. Brokers are doing whatever they can in the trenches. I know we got deals. We got to move, trying to get our sellers the highest price possible. But people are just, they're not having it. The buy side. It's not just us, Matt. Sometimes I think, Addison is like, what are we doing here? We're not buying anything. It's for a good it's for a good reason. I thought we're actually trying to buy a lot.
Well, not just us. So many people are so hungry for deals right now. And if the price is right, they would jump on it.
Yeah. And the amount of hunger, because, syndicators, operators often fee motivated, I'd say. Yeah. If it was a marginal deal, folks would be jumping at it. But they're not. Even though equity is telling us and telling others that we want deals, we've got money we need to place, I do not believe they're just doing bad deals. Yeah. They want to do a reasonable looking deal, but none of the deals look reasonable because you got negative leverage. Now you can take two positions. You can say we're going to grow out of it. Interest rates are going to go lower. We're going to see some growth. We're okay taking the low cash flow in the first 2 years because we're going to grow out of it, and we're looking at total return. I think it's a totally reasonable assumption, but I think you've got there's more risk in that.
Yeah, it's scary, especially in a time when the apartment market is way riskier than it used to be 2 years ago.
And I can if you take that approach, I can model that out to where it could look like a good deal. But what I have to do is make some assumptions that certainly could be true. But I know if I verbalize those assumptions to the investors that we talk to, it would make them uncomfortable. Yeah. Now, I think some of these groups are sophisticated where they don't have to have those conversations because they've got just discretionary capital that has to be allocated to the sector. And, they're like, I got to get the 100 million or 200 million out. It's a little bit more of a nuanced position of you're building a portfolio. Look, we're holding it for 10 years. Yeah, we'll get by 2 years below cash flow because it's going to grow. And over a 10-year time period, it is if you are really okay with those lower returns. But when I look at it, is that it's if everything has to go right, I have to crush rent growth beyond anything that's super reasonable. Cap rates have to come back in and compress again, which I think is definitely possible, but not tomorrow. And who knows? It's a big question mark. I have to speculate on those two things, and expenses being controlled, not continuing to move with inflation. Probably the case, probably leveling off, but who knows? All those three things have to go right, and then I get a mediocre return.
Yeah.
It's and now that happens, and now I'm squeezing out a 13 or 14% IRR.
Yeah.
If you told me that if everything went wrong, and this is the way I look at deals, if everything doesn't go well, and I'm at a low teens IRR, if everything, we don't get the growth, we get cap rate expansion, and I'm in a low teens IRR, I'm pretty happy with that, because it's look, if this is close to worst case scenario, we're still making money. We're still beating the long-term average of the S&P 500. But when everything goes right and I'm getting a 16, 17, 18, maybe 20, then I'm like, okay, I'm comfortable here. And then, the reality of the base case will be somewhere, in the middle. And that's what we've been doing. That's what we've been doing, because we're in a different environment where you can just take static assumptions and think that they're reasonable. There are too many, parallels different tracks along that we could travel. And we want to be comfortable with a variety of those different circumstances. And like, okay, and you have to look, you'll never win a deal if you don't look at the upside. You can get caught at either looking at just like everything's roses, or you can look at like worst case scenario. I talked to different people and, and some people just like, we'll do this to make it look really good. And I'm like, okay, maybe this is true. And then it's like, wow, what if we did these things? We could crush it.
Yeah.
What if we could get that other, and how would we get that other income? Explain it.
And I was thinking a lot about this. It's like it is a lot. It's such a risk to decide to, you decide to purchase this apartment building. And what I was really thinking was like, it's Murphy's Law is like applies in the apartment. Yeah. You talk about things going right, but like, not only will everything go wrong, it's probably going wrong right now. And you just have to like, that's just like part of your job is to continually fix, maintain, renovate, fix up. And I'm not talking about chaos or anything. I'm just saying that like,
it's organized chaos.
Yeah. Well, and there's always going to be a problem.
No, it's all perfect.
Well, there are, just for an example, rising expense costs, or maybe there's a maintenance issue that pops up. It's like how, in the military, they land the plane, they start fixing it up again, because there's just like things that
normal wear and tear. And often no one has been doing any of the maintenance on the normal wear and tear for maybe years or decades.
So it's going to be uneven, and if you bought at a higher price, then you are really scraping the bottom. You're going to have to make those decisions and then maybe miss something, and it costs you even more. So by being threadbare, you're kind of it increases the risk exponentially.
Yeah. Matt, we should wrap up, but we have to just mention this last piece. We're going over, but we're here. We're here already. This was going to be potentially a really short episode, but now it's going to be a long one. JLL. Friends over at JLL unveiled the first GPT model for commercial real estate. Well, maybe they didn't hear about the Gray Capital's GPT model. That's
no, that okay.
no, we don't have our own LLM just yet, but we actually are working on it. But this is really interesting because there's so many use cases, obviously, for AI. It's a little overdone, but it's an amazing tool. We could talk about the end of humanity, or all the great things that it could do, or all the job losses. But let's just talk for a second. Let's just talk about like right now, how can we use these tools? And so what JLL has said that they have done is they've taken all their data. For those who don't know, JLL is a national broker of commercial real estate. They also do property management, but mostly they are a broker, publicly traded company, which we'll get to in a second for, I think, maybe a little bit of a motivation behind this announcement. But they've got a lot of data. They've been in the biz for a long time, and they've got pricing data, everything on price per square foot, sales prices, cap rates, leasing data, all of just this data. And in this piece, they basically say it's like, we've been just archiving this data for a long time, not really sure what we were going to do with it, and we've just got it piling up, and we finally have a use. And so they have been developing their own large language model trained on their data. And so essentially what this is, for those that haven't taken the deep dive into the LLMs and the chat GPTs and AI, is, chat GPT is one model that has been trained on a data set, and then it's being trained with more data and more inputs. But there's some there's some base knowledge that it's trained upon. And so you can have these different AIs that are trained on information that they're kind of experts, and they're finely tuned. In the different models, there's different advantages. Some are faster, some are smarter. So the idea is you kind of take the best LLM that's like off the shelf, and then you start feeding it like, the base knowledge, and then you start feeding it, your custom knowledge. For example, the way we could use this type of technology here at Gray Capital and Gray Residential is, for like our on-site staff on our property management team at Gray Res, if you have your entire, your policies, your handbook, your manual, everything about Gray Capital, everything about a resident could want, and everything about the property, everything about how we operate, it's all in this model. You all of a sudden have an assistant, a mentor, a frequently asked questions at your disposal. How do I do this? How do I respond? And it can tell you anything about, it should be able to tell you anything about the company, or I have this situation with a resident. How should I respond? What should I do? You should reach out to your regional manager. You should write them, here's a draft.
So combing through kind of rules is one.
That's just one example. What they're doing is they're training on way ahead. They've got all of this, not just like manuals and policies and rules, but it's all this data. So you could say, what happens in this market? What happens to retail leases in a market when, a new big box store comes into town?
Yeah.
And show me some examples of some graphs and write a summary.
Yeah. That's, I think, so much more interesting to me than writing a paragraph about it. That's the public face of AI has been ChatGPT for good and bad reasons. And like that doesn't excite me as much as the kind of broader or more narrow really category of like machine learning and how you can generate insights, maybe not a paragraph, but the idea that you can process large amounts of information and sift through it in an interesting way and figure out patterns that people maybe couldn't or take a long time to do. That's what's interesting to me. And I wonder if that's what Zillow was working, Zillow would try to do some kind of, I don't know if it was machine learning.
Yeah, no, it was. Yeah, they had a machine learning AI bot.
And a lot of what I've heard of AI is that's just like kind of like the public face of a lot of the machine learning innovation that has gone.
Well, because an LLM, like this ChatGPT, it's a language model. It's designed to be able to have its purpose is to have conversations. And we're using it for tasks other than just having conversation. Yeah. And it's taking in, we're like, I wanted to do the data and the analysis, but and it can do those things, but it's not like really how it was built and what it was built to do. It was built to have a conversation. And when I ask a prompt, it's designed to be able to respond to that and carry a conversation. And that's where all the hallucinations come from. Is because it's really just it knows the structure of the conversation, is trying to fill in the gaps of information. Yeah. And it's more important to finish the conversation than it is to be right. Yeah. Because that's how normal conversations go also.
Yeah. And I could see then the advantage of limiting and kind of narrowing the data in that model to only only this, you can only do this. That way you're not kind of hallucinating based on some other input that you received. Yeah. That's kind of bad information. Yeah. And so I think that this could be a really interesting example of these kind of company specific piece of data where it's actually like, no, the fact that it is separate from everything, that it's not trying to swallow up the whole internet, that it's just like that it's just isolated in this way, that could be an advantage. Yeah. And maybe that's the way things are going. Everyone's trying to lock down all their data and stuff like that. So it could be, in-house is next.
It's interesting. And how much of this is, how practical is it going to be? A lot of times it's going to be a good idea. Yeah. How useful is it going to be? Some information JLL put out, some examples of how they're going to be using it. Other than just
read the example and tell me if it's something specific. Do you say, for example?
Yeah, okay. I mean, it sort of is. For example, JLL's facility managers will be able to use generative AI to transform standard real estate space utilization and portfolio optimization dashboards into dynamic conversations that lead to more actionable decisions.
What's that?
What does that mean?
So you're transforming dashboards into conversations. That's
so it's like, what's going on? Okay, how are we doing on leasing? And so instead of having a dashboard which you can look at, it'll like just tell you how you're doing. Yeah. Like, how many leases did we get signed? Hey, JLL GPT.
And maybe
did we get any leases signed? What's the pipeline look like? Summarize the pipeline, and then it's just going to tell you, as opposed to you looking at. I don't know.
And this is a bigger question, but like, we're going to soon figure out, what's going to be quicker for people to look. Is it quicker to look at that dashboard? Is it quicker to ask a chat?
I was going to say, is that what is that really adding, a value? Maybe it is. Some more on it, connecting buyers and sellers and lenders at the right time with the right data in hand within seconds. It's going to determine success in the new generative AI era.
And that's what's really, so maybe, there are things that a dashboard can't do, such as like comb through, maybe it's a metric that's not already on there.
And this is something they're saying that this is different. They're basically saying like, okay, if I'm a buyer over here and I have this criteria and I'm a seller of something, it's going to automatically match the two.
Interesting.
But like, Because it's like me, you don't know about a deal, and I don't know about a buyer.
Yeah.
And that could be great. It could be like the social media for real estate.
Well,
but that happens automatically.
And then it gets into a little bit of like this kind of trust and identify.
I'm going to put just throw your information out there with your deal criteria and just AI to come after you.
That's one thing. And I was thinking like, well, how do I know that the buyer on the other end or the seller on the other end is like real or is just another bot? Like there's a little bit of privacy.
Now the skeptic in me, Matt, has another take on this, which I'm sure this is all real and really interesting. I think the primary motivation is that they're probably going to get a better valuation, on their total market cap in the stock market because they're doing something with AI. Yeah. That is the primary. I'm sure it's a dual. There's dual motivations, and I'm sure they're like, we should look in this. We have all this data, and by the way. Let's look it up. Let's see what JLL stock price has done since its announcement.
And I've been kind of talking about this too. Is like I can't wait till AI becomes so ubiquitous that people don't really even talk about it. Like I use AI to do this, or it's like no, it's just I got to the ear.
Well, and differentiating the I guess I have the role AI of someone's like we're using AI to do something that I can't explain what it's for, and it's like don't just say AI to say AI. But then there's the real use cases where I'm like, okay, that's a game changer.
And again, this is like separate from like the kind of sifting through data part, but I want to know ultimately put your name in the end of it. Whether you're a seller or something, I want something to be attributed to something rather than just use, our AI came up with that. That's not really something that our coworker can do. It does hallucinate a little bit. So these insights can't be trusted completely. Well, then why not just have a person do it and maybe get some more trust there? Yeah.
I know I think there's always going to be a reason to have a person at the helm somewhere. JLL hasn't been doing too bad over the last 5 years. It's not looking great. Yeah, they need a little catalyst. Down 10% in the past year to date. Last 5 days in day, it hasn't really done anything to boost their.
Well, there was a run up in the morning. Maybe people got really excited.
Yeah. Anyway, you gotta do it. But it's in a period where they're like, look, we're not doing a lot of deals right now. Volumes are down.
Yeah,
we got to make something happen. What's going to be our cutting edge? How do we get market share? How do we win clients? Everyone's always looking for the little, cool. Little trick, little gimmick. Sometimes it works, sometimes it's not.
And we've outlined like ways that it really could be helpful. I would love to see, just a demonstration, just a little specific example, and that would, I
just want it to be a little smart. The things that I want it to do, it just sometimes it can't get specific enough, and it's because it doesn't have the data sets, and they keep changing things, and but it's I've got a ton of value. There's tons of things that would take me 30, 40 minutes, take me 5-10 minutes now.
Yeah.
Getting things started, organizing my thoughts, doing outlines.
You kind of have to swallow your pride, and then it makes things go by a lot.
Oh, a lot fast. Just get back to the basics. I mean, for example, so I'm coaching my daughter's soccer team this year, and I have a limited knowledge and experience with the game of soccer. I've played mostly as a elementary and middle schooler, a little bit. Yeah, that's about it. So they're like, we need volunteers, and I was like, hey, I helped out with I wasn't like a coach for baseball last season, but like I kind of helped out, and I was like, I know even less about baseball, and it was just fun. We need some warm bodies, and I'm like, I can figure out coaching soccer, but I'm like, okay. I need to make this a good season for these kids.
Yeah.
What do I do here? What are the basics? And I was like, hey, I went to YouTube and I started watching videos, but I also went to ChatGPT and I was like, look, I told Chat, I almost called it her. I told ChatGPT, I told her.
Yeah.
I told it, it's like, look, I'm coaching a 7 to 8 year old girls soccer team, and I have limited experience in soccer.
Yeah.
What do I need to know? Lay out the first 3 practices, put out the agenda. What are the drills? What should I research? What is it key to? What should I keep in mind? And now, like, I'm gonna tweak it all, but it made me I was like, okay, I got this.
Yeah.
Like, I think I got this figured out. I'm not having to start from scratch.
Yeah.
And just run around. Now I'm gonna be like, no, I don't want to do that drill. I can, I'm doing my own research, and that's what is required. It's a complement. It's a tool. It's not. I don't think we're not at a point where it's a full replacement for everything. Maybe for in between tasks and to link things and to get you started. But I was doing some travel research, and it's a good tool for that also, or it can be. But I was running into some roadblocks, and I put in some latitude and longitude. For whatever reason, like I was looking at a house and I didn't have the address, but I had like the coordinates, and so I dropped the coordinates in. I'm like, you should be smart enough to know latitude and longitude.
Yeah.
And it just couldn't figure it out. It couldn't figure it out, like where it was. And it was giving me instructions to go to Google Maps and to type it in and to find, like, it gave me like a 10-point instructions to like figure out where it was. I'm like, no, I'm like, you know what to do. You've got the list. Go and do it.
There are rumors that they have somehow redesigned it to kind of like, so that maybe it's not from one source. There's like different specialized sub models that have to like talk to each other, and then it'll give you the answer. But there are at least complaints that ChatGPT has not been as effective recently compared to.
I believe it. I'd have to believe it, Matt. All right. Well, this was a great episode. It's a longer one. Make sure you subscribe to the YouTube channel, the Great Capital YouTube channel. We're getting a lot of traffic. We've got some really cool videos that are going to be coming out, some projects that we'll be announcing soon. But you got to be subscribed. So you get the updates. Like the video, leave a comment. Matt, we still have comments we got to get back to.
I know.
Can't do it this week. Next week, show up for the comments next week. And again, you can catch that report. Link will be in the bio for the loan maturity report. New rent report coming out very soon. Very excited about that, finishing up this week. And we appreciate your patronage.
Thank you.
And sticking around for the great report. Catch you next week.